Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of how to borrow stocks and potential short squeezes. Today we're putting a spotlight on a company that recently triggered some serious alerts on our screen at RYOJ, or RYOJ Bobber Company, Limited. We're going to break down why this stock is catching our eye, what it means for short sellers, and what you need to understand about the mechanics at play. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show RYOJ logo/ticker. Let's get straight into it. RYOJ Bobber Company Limited is a Japanese company operating in the industrials and consulting services sector with a current market cap of $44.08 million. They provide consulting and health services broken down into two main segments: consulting services, which supports labor unions and companies, and health services. Now, while the business fundamentals are important for long-term investing, today we're focusing on market mechanics. So chart, RYOJ 30-day price action. Looking at the recent price action for RYOJ, it's been quite a ride. Today alone, the stock is up a significant plus 31.53%. Over the last 5 trading days, it has surged by plus 46.42%. However, zoom out to the last 30 days, and RYOJ is actually down minus 24.66%, indicating some serious volatility. Volume has also picked up. Today saw 680,000 shares traded, slightly above its 30-day average volume of 593,013 shares, giving it a relative volume of 1.1x average. These swings are exactly what can catch the attention of both short sellers and those looking for a potential squeeze. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? At its core, it refers to the cost associated with borrowing shares to sell them short. When you want to short a stock, you essentially rent shares from someone who owns them to sell them, hoping the price drops, and then buy them back at a lower price to return them. The fee you pay to rent those shares is called the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. So, a 100% annualized CTB means that if you held that short position for a full year, you'd pay a fee equal to 100% of the stock's value. It's a direct and continuous strain on a short seller's profitability, and it's a crucial indicator for potential short squeezes because it reflects the supply and demand dynamics for shorting that specific stock. When this number gets extremely high, it signals significant scarcity of shares available to short, or very high demand from short sellers, making it an expensive bet. Why this stock is hard to borrow right now. Show screen of data for RYOJ. Now let's talk about why RYOJ is on our radar. The numbers here are truly striking. RYOJ currently has an annualized cost to borrow fee of a staggering 554.0%. Emphasize that's not a type of 554%. This is an exceptionally high fee, indicating that finding shares to short RYOJ is incredibly difficult and expensive. To make matters even more intense, the CTB has seen significant momentum, increasing by plus 54 percentage points just over the last 5 trading days. This rapid rise suggests a tightening supply or increasing demand to short very quickly. And here's another critical data point: there are currently only 2,000 shares available to borrow for RYOJ. Highlight when you consider the estimated float for RYOJ is 2.3 million shares, having only 2,000 shares left to borrow is an almost negligible amount. This extreme scarcity means that virtually no new short positions can be opened, and existing short sellers are in a very tight spot if they want to cover or adjust their positions. Our internal composite squeeze score, which combines factors like CTB, borrow supply, and price momentum, currently sits at 43.1 for RYOJ, indicating a notable, but not yet extreme, squeeze potential. Squeeze mechanics explained. So, how does this extreme hard-to-borrow situation lead to a short squeeze? It's a chain reaction. Short sellers borrow shares and sell them, betting the price will fall. If the price instead starts to rise like RYOJ's plus 31.53%, these short sellers start losing money. The high cost to borrow, now at 554.0% for RYOJ, acts like a ticking time bomb, eating into their profits and potentially forcing them to cover their positions just to stop the bleeding from fees alone. When only 2,000 shares of RYOJ are available to borrow, it severely restricts new short positions. Existing short sellers who want to close their positions must buy back shares from the open market. This forced buying pressure drives the stock price up even further. As the price climbs, more short sellers face margin calls or simply decide to cut their losses, leading to even more buying to cover, creating a rapid upward spiral that's the essence of a short squeeze. Dilution risk check. An important factor in any short squeeze thesis is the risk of dilution. Dilution occurs when a company issues new shares, effectively increasing the total share count. This can be a death knell for a potential short squeeze because it floods the market with new supply. More shares mean short sellers can cover their positions more easily, or new short sellers can enter, counteracting the scarcity that drives a squeeze. It essentially provides an escape route for short sellers. For RYOJ, our checks show no recent dilutive SEC filings, no -1s, -3s, or 424 BS found in the last 90 days. Furthermore, we haven't identified any recent reverse splits in our look-back window. This is a positive sign for the short squeeze thesis, as it suggests the company isn't currently adding new shares that could dilute existing shareholder value or provide an easy out for short sellers. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. While RYOJ's numbers are compelling, it's crucial to understand that a high cost to borrow does not guarantee a short squeeze. Sometimes, short sellers have very strong conviction that a stock is overvalued, and they are willing to pay extremely high fees to maintain their short positions. They might believe the stock is destined for a significant drop, making the high CTB worth the risk. So, what should you watch for with RYOJ? First, continue monitoring the cost to borrow for RYOJ. Any further increases would signal even greater pressure. Second, keep an eye on the shares available to borrow. With only 2,000 available, any further reduction would be significant. Third, sustained price momentum, especially on increasing volume, would be a key indicator. Today's plus 31.53% is a good start, but consistency is key. Lastly, watch for any news or developments from RYOJ Boba Company Limited itself that could impact sentiment. In summary, RYOJ, or RYOJ Boba Company Limited, presents a fascinating case study with its exceptionally high 554.0% annualized cost to borrow and a critically low supply of only 2,000 shares available to borrow. Coupled with its recent positive price momentum and no immediate dilution risk, it certainly fits the profile of a hard-to-borrow stock with potential squeeze dynamics. But remember, the market is unpredictable, and these situations are highly complex and carry significant risk. Always approach with caution and a deep understanding of what you're getting into. If you found this breakdown of RYOJ insightful, please hit that like button, subscribe for more in-depth analysis, and let us know in the comments if you have any questions or other stocks you'd like us to investigate. We'll see you next time.